Although there are some ways to avoid it, most home buyers using conventional financing options will likely have to incur mortgage insurance as part of their monthly payment, which is separate from homeowners insurance. And this is an important subject that needs to be factored into the analysis when comparing options for financing a home. Clients typically focus on rates and down payment requirements for a program, and with good reason, but often too little attention is given to the subject of mortgage insurance and the significant role that it plays in the overall monthly cost of home ownership, both now and in the future. The good news is that the cost of mortgage insurance has come down over the years. So there's less reason to try other workarounds to avoid it. And also the fact that it can be dropped after certain minimum time periods have elapsed and key equity positions have been obtained. Although there are few guarantees specifically laid out in the mortgage paperwork homeowners will sign at closing, other than the fact that due to federal law, mortgage insurance will disappear automatically after the loan balance drops to 78% of the original purchase price or value, whichever is lower, or that an owner can request it to be dropped at 80% of that same original value. And that's great to know. But generally, with Fannie Mae and Freddie Mac loans, you also have the opportunity to request that mortgage insurance be waived in as soon as 3 years and possibly even two as an exception, provided the homeowner has at least 25% equity in the property based on the current market value and loan balance, which will require an appraisal that the homeowner will need to pay for. Or it can get dropped after 5 years, provided there's at least 20% equity. So again, 25% equity to get out of it in 2 to 3 years and 20% equity in 5 years. But the key here is that it is based on current market value, not the original value. So future appreciation comes into play in this case versus the automatic waiver after the balance drops to 78% of the original value. Now, there can be other requirements, like the request has to be in writing. You need to be current on your payments with a good payment history, and you might not be able to have a home equity line or loan on your home at the time of the request, which may catch a lot of people by surprise. Now, of course, many homeowners also create a win-win scenario by refinancing their current loan containing mortgage insurance if rates have also dropped while their equity is increased, in which case the lender will simply use the current value to determine whether mortgage insurance is required. And often homeowners can both lower their rate along with dropping mortgage insurance. But if rates are higher now than what they originally had, they would probably want to avoid refinancing and would look to eliminate it through future increases in equity alone. Plus, you have to consider the closing costs of the refinance and justify those costs with the savings. Now, with jumbo loans, the options can vary depending on that particular investor. And keep in mind that with most FHA loans, you usually don't have the opportunity to waive the mortgage insurance at all, regardless of increases in property value or any pay down of principal without going through a full refinance. Again, as with so many subjects related to home financing, this is an area where home buyers need an experienced and trusted mortgage professional to walk through these options and offer honest advice to their clients about all the pros and cons among the many options available to them when selecting the right financing product. So I hope this has been helpful. Please feel free to reach out to me anytime I can be of service. Thanks and have a great day.